Everyone, I am Dr. Sarika Makol, Associate Professor in Sagar Group of Institutions. Today, I am going to discuss about investment process in the subject Security Analysis and Investment Management of MBA 3rd Sem. Moving on to the first slide, before going for the investment process, first we should know about what is investment. So investment is the employment of funds on assets to earn income or capital appreciation. So basically we'll employ our funds or assets so that we can earn return in the form of income or capital appreciation. And the individual who makes an investment is known as the investor. Now, in the terms of economic and financial terms, what is the meaning of investment? In economic terms, investment is defined as the net addition made to the capital stock of the country. So basically, if we add something into the infrastructure of the country or the other developments, so that is also a form of investment. So that is known as investment in economic terms. Whereas in financial terms, investment is defined as allocating money to assets with a view to gain profit over a period of time, as it is related to the future period of time. So in terms of economic and financial, the meaning of investments is interrelated, wherein an individual's savings flow into the capital market as financial investment, which is further used as economic investment. So basically what we are doing is making our investments in the capital market, and that will help you in the development of the country. So this is the meaning of investment. Now these are the objectives of investment for which we are making investment. So we categorize this into two types: main objectives and other objectives. So there are two main objectives. Basically we are doing investment to increase the rate of return and to minimize the risk. Whereas the other objectives are to increase the liquidity, to increase the safety level, as well as it helps you to hedge against the inflation. As we know that day by day the rates are increasing, so to reduce the risk of that very inflation, in that case also we can make the investment, or in other words we can say that investment helps us to earn good returns in the situation of high rate of inflation also. So these are the objectives of investment. Now, the main topic of ours is the process of investment. So the process of investment includes basically 5 stages. So it's a 5-step process in which the first step is investment policy, second is security analysis, third is valuation of the shares, fourth is portfolio construction, and fifth is portfolio evaluation. So we'll do all these 5 steps one by one in detail. So now the first step is investment policy. That what could be the policy of your investment. As you all know that the stock market is following the rules and regulations of SEBI, that is Securities Exchange Board of India. So everything is legal and everything is written, everything is organized. So the government or the investor, before proceeding into the investment, he formulates the policy for the systematic functioning of the investment. So in the first step, we can say the essential ingredients of the policies are 3. That is investable funds, objectives, and knowledge. Now what do you mean by investable funds? As I told you earlier that investment is only done with the help of savings. So if you have no savings, you cannot make investment. So investable funds means that what are the availability of funds with you to make investment. That funds may be generated through savings of yours or from borrowings from the other parties. Like for example, if we issue the shares in the market, so we are borrowing the money from the public. So that can also be known as your investable funds. Means the funds which are available for investment is known as investable funds. This is the first ingredient. Now the second thing before making the investment is objective. That what are your objectives after making investment, behind making investment. So the objectives can be framed on the premises of it may be required rate of return, it can be regularity of income, it can be risk perception or risk reduction, or it can be the need for liquidity. So each investors can have different objective. No two investors can have the same objective of investment. So according to the objectives, one can make investment in the particular alternative or in the particular security. Now the third essential ingredient is knowledge. This is very much necessary that you should have the knowledge of the market. The investor must know about the market, must have the knowledge about all the alternatives available in the market. He should know about the risk and return associated with the investment alternatives, because that normally differs from one investment alternative to another. So the knowledge of the market is must. So basically all these three ingredients for the investment is essential. So you must keep in mind, before making investment, the very first step is to work upon these three ingredients. Now the second stage, after analyzing the investment policy or after deciding, the next thing is you have to analyze the securities in which you want to make investment. So the securities to be bought have to be scrutinized through these three analyses. One is market, second is industry, and third is company analysis. We just go like this. The group of companies make industry, the group of industry make market. So before making investment, first of all, the investor has to decide that in which market he would like to invest. Whether in the domestic market, means in his home market, or in the foreign market or international market. After deciding the market, and that market analysis will be done on the basis that he have to analyze the political factors of the particular country, the economic factors and the social factors of that very particular company, as well as the foreign exchange policies, because foreign exchange policies plays an important role. So that is why it is necessary that the market has to be analyzed. Once the market has been identified that in which market he would like to invest, then another thing comes industry analysis. Then he has to decide that in which industry he has to make investment, like retail industry, automobile industry, pharmaceutical industry, banking industry, in which type of industry he would like to make the investment. And industry analysis will be done with the help of the sales, profitability of that very particular industry, growth of that very particular industry in the recent years. So on the basis of that, he will take the decision. After deciding the industry, now he have to decide that in which particular company he would like to invest in that very particular industry. Like for example, if we have chosen pharmaceutical industry, so pharmaceutical industry is the combination of different companies of pharmaceuticals. So then he have to decide that in which company he has to invest, and that company analysis can be done on the basis of sales and revenues of that very particular company, then the employees turnover ratio of that very company, profit of that very particular company. So accordingly he have to decide that in which company out of that very particular industry he has to make investment. So all this concludes your security analysis. So on the basis of the analysis of all these three things, he can just find out that in which type of securities he has to make investment. Now the third stage comes out of valuation of the shares. That once he decided that in this very particular company he has to make investment, now the next step he has to do to value the shares of that very particular company. So the valuation helps the investor to determine the return as well as the risk expected from that very particular investment, because as you know that these are the two important components of investment, that is return and risk. So the first thing is that he has to measure is intrinsic value of the share. Now the question arises, what is the intrinsic value? So the intrinsic value can be referred as true value of the company as perceived by the trader or investor. This is the true value of the company, which can be measured through the book value of the share as well as the price earnings ratio. So here I have used these two terms, that is intrinsic value and price earnings ratio. So first of all, we'll be able to understand what is price earnings ratio. So this is price earnings ratio. Price to earnings ratio is the measure of the share price relative to the annual net income earned by the firm per share. So it means that P ratio shows current investor demand for a company share, that how much the shares of the company is demanded in the market. So that depends upon the earnings of that very particular company. So in other words, we can say that PE ratio denotes what the market is willing to pay for a company's profits, that how the market would look about that very particular company. Yeah, in other words, we can say that what is the goodwill of that very particular company in the market. So we can say that earnings are important when valuing a company's stock, because investors want to know how profitable a company is and how profitable it will be in the future. So for that, he should find out the price earnings ratio. If it is high ratio, so it generally indicates increased demand, because investors have anticipated that there is a growth in the earnings of that very particular company in the future, and vice versa is the case. If the P ratio is low, so it indicates decrease in the demand of that very particular shares of the company. So this is the formula of the price earnings ratio, that is equals to stock price per share divided by earnings per share, or another formula is market capitalization divided by total net earnings. So now what is market capitalization? Market capitalization is the multiplication or is total outstanding shares multiplied by the current market price of the shares of the company. So that is the market capitalization. So I hope the price earnings ratio is clear to all. So now moving on to the next point. The stock market analysis have developed many advanced models to value the shares. So the real worth of the share is compared with the market price, and then the investment decision can be made. Here the real worth means the worth of the share as per the price earnings ratio, and it can be compared with the market price. Now another important concept is the future value of the share. Like through the price earnings ratio, we can anticipate that if the high ratio is there, so it means in the future period of time, the value of the shares of that very particular company can also be increased. But future value of the securities could be estimated with another method also, by using a statistical technique like trend analysis. That on the basis of the past trends of that very particular company, we can also analyze the future value of the securities of that very particular company. So on the basis of this trend analysis also, the investor can decide that whether to invest in the particular company or not. So this is the third stage, that is valuation of the share. Now moving on to the fourth stage, now we have decided with the investment policy, we have analyzed the securities in the market, industry and company. Then we have just analyzed the valuation also. Now the fourth stage is that you have to construct your portfolio. Now what is portfolio? A portfolio is a combination of various alternatives of securities. Like for example, we cannot make in total investment of our savings only into one type of securities, that is shares, because that increases your risk. So the portfolio is constructed in such a manner so that the investor can meet its objectives also. And the main objective of the investor is to attain maximum returns with minimum risk. In the case of the investment, we cannot eliminate the risk. Why? Because future is uncertain. So some or little bit kind of a risk should always be there. So we can only do one thing. We can take the measures to reduce our risk. So that is why towards this end we can just do to diversify the portfolio so that we can allocate our funds, we can allocate our total funds among the different securities in such a manner that the objectives of ours could also be achieved, and we can also achieve the objective of maximum return as well as minimum risk. So the word which we use for this is diversification. So basically diversification is the term which we can use to maximize our return and minimize our risk in which we can allocate our funds to just diversify our risk among the various securities. So in this diversification, we can allocate the funds in the various securities like equities, debentures, fixed deposits, real estate, gold, silver, whatever. So you can make your portfolio according to your objective as well as the risk bearing capacity of the investor. So that is the meaning of diversification. Now there is a categorization of the diversification. First is debt and equity diversification, which means that you can make your portfolio with a combination of debts and equities. So now in this kind of diversification, the ratio can vary from investor to investor. Like if one investor wants growth in their income, so definitely their portfolio would contain more of equities and less of debentures. So it can be 70% plus 30%, it can be 80% plus 20%. But if the investor needs safety of their principal amount, then the proportion of equity investment would be less, whereas the proportion of debt investment would be more in his or her portfolio. So in this way, he or she can diversify their risk between these two securities. Next type of diversification is industry diversification, in which we can make the portfolio of different industries. So we can take 2 industries in one portfolio, 3 or 4 industries, whatever you want. Like for example, we can make the portfolio of or a combination of retail industry plus banking industry plus pharmaceutical industry plus automobile industry. It means you will divide the proportion of your investment in these 4 types of industry as per your objective. Next is company diversification. After doing industry diversification, then you will select the companies in which you make the investment and accordingly make your portfolio. After making these portfolios, you will select the shares and you will generate the portfolio of your securities. So this is known as construction of portfolio. After constructing the portfolio, now the question arises that the market cannot remain constant. It keeps on moving, it keeps on fluctuating. So can we revise or can we change our portfolio? Yes, you can. You can change your portfolio, but after making the appraisal of your portfolio. So the portfolio can be managed efficiently with the help of evaluation step or the last stage of this investment process. So this contains portfolio appraisal as well as revision. Now what do you mean by appraisal? The return and risk performance of the security vary from time to time as the market always changes. It cannot be stable. So the variability in the returns of the securities can be measured and compared. And it can be measured on the basis of the developments in the economy, developments in the industry, as well as the relevant companies from which the stocks can be bought have to be appraised on the basis of their return as well as risk level. Say for an example, in the current scenario when the corona is moving on, we all know that the pharmaceutical industries are growing like anything. The stocks of that very companies are appraised. Why? Because the returns in that very industries are increasing, whereas the risk level is less. So in this way, you can just appraise your portfolio in context of return and risk. The revision point depends on the results of this appraisal only. The low yielding securities with high risk. The low yielding securities here means the securities which are earning less returns but having high risk can be replaced with the securities those are earning high returns with the low risk factor. In this way, you can revise your portfolio and get better returns. So keep the return at the particular level necessitates the investor to revise the components of the portfolio periodically. But here periodically doesn't mean that you can revise it in 15 days or you can revise it within 7 days. try to revise it with a proper span of time, because it has been said that never get panic while making investment. You have to hold the securities, you have to see the situations properly with a calm mind and then react to the situation. Do not react abruptly, because if you got panic, if you react abruptly, that will just give you the losses only, not the profit. So be calm and take the wise decision while revising your portfolios. So thank you all.